One of the most costly penalties imposed by the IRS is on your retirement assets. And if you don't manage this properly, you could be hit with a 50% fine. I'm going to share with you how to best manage your retirement side of your portfolio so you can avoid this costly mistake. Hi, my name is Mark Singer, founder of Your Retirement Authority. And before we get started, please subscribe to the channel and hit the alert button so you're notified when we post new videos. So I want to share with you a true story. This happened, I don't know, it was about 3 or 4 years ago. I had a new client come into the office. He had over $1 million in his retirement portfolio. And at the time, he was over 70 and a half. He had just achieved that magical age where you needed to start your required minimum distributions. He was unaware of what exactly he needed to do, so he just sort of pushed it off. And this is what happened. The IRS ended up finding out because they did audit his taxes. And he was supposed to take out in that year $50,000 from his portfolio that he did not. Well, the IRS imposed a $25,000 fine, 50% of what he was supposed to take out, which was the $50,000. He had to take the $50,000 out. Then he also had to take out the $25,000 because he had no money elsewhere other than just in his retirement portfolio, and be taxed on that money as well. So not only did it cost him a $25,000 fine, it also cost him $25,000 that he had to pay taxes on unnecessarily. You can avoid this. Let me show you how. So let's start off the discussion with sharing with you some of the basic rules and some of the recent changes. The first change, the biggest one that happened last year, was we moved the required minimum distribution age, that initial age, from age 70 and a half now to the age of 72. So now you can wait an extra year, year and a half or so before being forced to take the money out. That's good news for most of our clients. You just need to be aware of it. A recent change, and this impacted those who were already 72 last year, who were in the midst of taking out the required minimum distributions in the midst of the pandemic. They were given the opportunity to suspend those required distributions. I do not see that happening this year, but if you did make that change last year to suspend or stop the distributions, you need to make sure that you trigger again those distributions for this year, because again, I don't want you to get hit with that fine. One of the other big changes that happened a few years ago is now that all of your custodians must report to you and to the IRS with regards to that you're now a certain age and you need to take out a certain amount of money. Now, this presents a couple of challenges for you. First of all, years ago, IRS didn't really know how old you were or how much you were supposed to be taking out, so it was difficult for them to go about and enforce and assess this penalty. But now they have this information. You are alerted to it. And every one of your custodians, and a custodian is where you have each one of your IRAs, sends you this paperwork. And I'm going to go through with you one of the challenges that poses, how it could complicate things for you and maybe put you in a position to be paying more in fines and taxes than you should. Before we go on, I want to ask you a question. Do you know if you're really prepared for retirement at this point? Well, what I've done as a result of writing the latest book, Don't Outlive Your Money in Retirement, 7 Key Steps, is we've created a quiz for you. And it's up in our YouTube banner. And if you click on the banner and go to the quiz, it's a 15-question, 2-minute quiz that once you finish it, we will score it for you to give you a sense of which one of the 3 stages of retirement preparedness you are in. And also, I want to make sure that we give to you enough value if you finish the quiz. Very easy to do that. I'll share with you, a chapter from the book and also give you a couple of worksheets so you have a little bit more clarity with regards to your journey into retirement. So let's get back to now understanding required minimum distributions. And, the very first thing we have to understand is, why is there such a thing? Well, the answer is that for all of these years, we have been allowed for this money to grow in a tax-deferred manner. And the required minimum distribution is the IRS, the government, saying, hey, at some point, we need to get our fair share as well. So now, with the new rule at age 72, you're now going to transfer, in essence, some of this money from the tax-deferred account into a taxable situation where the money that comes out, you will have to pay taxes on. And that's at the very essence why there is a required minimum distribution. Now, one of the most confusing parts of this is about not so much how much you need to take out, I'll get to that in just a moment, but where you need to take it from. So let me give you an example. Let's say you are now about to go and enter this required minimum distribution stage. And let's go back for a moment and talk about that you actually have a choice in the first year and first year only. And this begs the whole question of planning. For many of my clients, they don't necessarily need the money that's being forced out by this distribution, but they have to take it, right? So in the first year that you're eligible for the required minimum distribution, you have two choices. One, you can take that first year's distribution out in that first year, or you could defer taking out that first year's distribution. It must come out by April 1st of the next year, and the second year's distribution must come out that year as well. So you're sort of doubling up. Don't know, for many people it makes sense to defer. You have to pay the taxes anyway, and it may bump you up into a different tax bracket by taking that distribution out doubly in the second year. But it's important to go back to your financial advisor to ask the question as to whether or not it makes sense from a tax perspective to take your distribution out the first year or move it into the second year. So let's talk about the distribution itself. In that first year, you really have to take out, let's call it 3.5%, give or take. There's an actuarial table of your money. So if you have $1 million in your IRAs and your retirement accounts, along with your 401ks, 403bs, you need to take out approximately $35,000. Certainly go to each custodian, your financial advisor, and get the exact number. I'm just trying to give you a ballpark, all right? So let's say you need to take out $35,000. And we're going to create a scenario where you have $1 million and you have 5 different IRAs, each with $200,000 in it. So the question is, where do you need to take the money from? And what the IRS says is, whether you have one pool of money, you have it all in one IRA, the $1 million, or you have 5 different buckets of retirement accounts, they only care that you take that $35,000 out. They don't care if it comes from one of the buckets or you take it from numbers of different buckets. They just care that it comes out. Many people are confused by this, and this is where it could cost you some money and not be taking out the right amount from the proper accounts, which may end up costing you fines and taxes along the way. There is one very important exception or exemption that you need to be aware of when it comes to the required minimum distribution. Let's say that you're still working and now you're past the age of 72. Do you need to take the money out? And the answer is no, unless you are more than a 5% or more owner of the business. If that is the case, even if you're still working, you need to initiate that distribution at the proper age. Now, I'm going to share with you two potential solutions to help you along this journey in terms of managing your required minimum distributions from your retirement accounts. The first is what I call consolidation. Let's get back to the fact that every custodian must send to you a letter each year. You may get 3, 5, 10 different letters. What do you do with all of this? We highly recommend for our clients, where it is possible, to consolidate as much as you can so that you have as few different buckets. That helps in terms of money management, and it also helps in terms of communication and getting a handle on where you need to take the money out of and where it would be most prudent to do so each year. So consolidation's a really big key in terms of managing your retirement assets and the distributions that you need to take out. The other solution might be, for some, a Roth IRA. And I'm not suggesting you convert to a Roth right now. I'm just indicating to you that if you had a Roth, there would be, for the owner of that Roth, no required minimum distribution. Now, this goes back to the whole planning, the essence of planning as to whether or not you should start a Roth, you should convert to a Roth. At what age should you convert to the Roth? Does it make sense for you to convert to the Roth? But you need to be aware of what the options are so that as you manage your retirement assets, you know which direction would be best for you based on your objectives for your retirement. I hope this has been helpful, and I truly hope that you enjoy the retirement journey, because I do believe you've worked hard for it, and I really want to make sure that you enjoy it. Thanks for watching.